Hello. So I am so disappointed that we didn't get the opportunity to meet today for our class to go over chapter 11. However, I do understand preparations have to be made. We have to think about our safety above all else. So I figured that what I would do is I would put together a series of kind of step by steps that I think you should follow, which kind of matches what we would have done had we had the opportunity to meet today. I was talking to some of the other professors yesterday about missing this class, and I kind of came to the conclusion, if there was one to miss, this was a good one to miss for this upcoming exam, because a lot of it actually has to do with, and I know I say this a lot, but it has a lot to do with what you learned back in Accounting 1, but so much so that you can kind of rely on a lot of the resources that we already have available for these methods, right? So chapter 11 goes into depreciation primarily. It also touches on depletion. I'm going to kind of introduce you to the big topic from chapter 12, which will be intangibles, but just so that you're kind of getting an idea about what we're doing, right? So when we're talking about depreciation, keep in mind that when we depreciate, we're depreciating our property, plant, and equipment, with the exception of land, right? Land does not get depreciated in accounting. However, when we have equipment, machinery, buildings, so on and so forth, those are items that would be depreciated. And there's many different methods that we can choose to do this, right? So let's kind of get into some of these different areas. They talk a little bit about impairments and write-offs in the beginning of this chapter, so I would highly recommend looking at impairments. You could have one or two questions on that on your exam. When we're talking about depreciation, depreciation is going to be one of the big problems on your exam. Now, there's many different methods that we could use for depreciation. Let's get down to those methods, right? One of them is the activity method. You may recall hearing about this method when you went over the units of production is sometimes what they call it, units of output, units of activity, so on and so forth. So there's many different words here. There's even another one here, variable charge. So essentially for this depreciation method, you are simply going to depreciate based on actual usage, right? So it's actually a really interesting one because it does really reflect how much you are using said piece of equipment to generate revenues, right? Another method that we go over is the straight line method. This is probably the most basic. It's very simple. It's equal depreciation each and every year, right? The next one that we have is, let me see, did I skip it? Straight line, straight line. Yeah, I'm going to move to this one next. Double declining balance method. In our textbook, they just call it declining balance. You probably learned it as double declining back in Accounting 1. So keep in mind when we're doing double declining, this is where we come up with our double declining rate. We multiply it by the book value, so on and so forth. For those three methods, those are the three main ones you learned back in Accounting 1. Your straight line, double declining, and activity method. The new one in this textbook is sum of the year's digits. Some of the year's digits may seem difficult, but I promise you it is not, right? So for our case in this book, and actually, funny fact is I just recorded a video for you guys for this one, and they use the same numbers. So that's a coincidence. So when you're doing the sum of the year's digits, your focus is going to be on one, finding your depreciable base, so essentially the amount that you're allowed to depreciate, and then you are going to be depreciating it using a fraction for each one, right? So if this asset has 5 years of useful life, what we do is we add up all of those years. 5, 4, 3, 2, 1, 15, right? Year 1 is going to get the most depreciation. They're going to get 5/15, 4/15, 3/15, so on and so forth. And then you're simply going to multiply that by your depreciable base. Keep in mind, depreciable base is your cost minus your residual value. But don't worry, I go over this in the video. You'll be able to see it probably in one of your further steps down. So those four depreciation methods are the four that you should know for the exam. There will be a problem on depreciation methods, so I definitely recommend getting comfortable with those. Other things to consider is that there are two additional methods here. a group method and a composite method. I will pick out some homework questions to go over in a video with you for those as well. Again, they're not going to be in the problems, but they could be in the multiple choice, so it's definitely a good topic to know. Let's keep going. Another important thing is going to be partial periods. When you go to your problem for this one, there is a possibility that you could be asked to do it based on partial periods. So I am going to ask that you pay close attention to partial periods when you are going through the homework in the book. I'm going to leave that up to you to study, but I will tell you, this is something you need to know. Please be sure that you review that. Let's see. Another big thing that we have to consider is a change in estimates. Let's see where they said here. So when we're talking about a change in any type of estimate, this could be a company deciding that the estimated useful life is supposed to be longer than was previously listed. This could be a change to the residual value, so on and so forth. So a change in something that they are estimating. These are going to be dealt with prospectively. And this is a really important word for those of you who are getting excited. I know I use that term a little loosely, but those of you who are getting excited about your next class, Theory 2, they're going to discuss the terms retrospectively and prospectively. So when your textbook tells you that some type of fix or some type of adjustment needs to be made retrospectively, what they're saying is you're going to have to change the prior periods, so all periods prior to the current year. But if they say prospectively, that just means now and going forward. So prospectively, we are going to be changing the current and prospective periods. So if we say that there was a change in the estimated useful life or in the residual value, we are simply going to deal with it from this point forward. We're not going to go back to prior years and fix it, right? So I'll make sure to pull up another problem that deals with changes in estimates as well, because that's going to be very important for us. All right, impairments. I want you to read through impairments. This is information that that could be tested on. Not too worried about that right now in the intro. Impairment losses, not too worried. Let's see, depletion. Depletion is another really big area you might remember from Accounting 1. You might remember at the beginning of this introduction, I said that depreciation is done on property, plant, and equipment, with the exception of land, right? Well, there's another concept that is very similar. However, it's done for natural resources. So things like our petroleum, minerals, timber, any of those types of natural resource deposits that we're going to have, we're not going to call that depreciation, we're going to call that depletion, and it's done a little bit differently, right? So there's many different costs that go into when we're figuring out depletion, and this is something that you should be very familiar with, is the acquisitions cost. Notice that they say the acquisition cost is recorded in an account called undeveloped property, and later assigns that cost to natural resources if it's successful. Right. They have exploration costs. They're talking about how we are going to treat these costs, development costs, restoration costs. So you should read through these sections in your textbook to see how we treat each of those individual costs for natural resources. Now, when we get to our depletion, notice here that there is a formula that we're going to use for depletion. So essentially we take our total cost, we deduct out the salvage value, and we divide that by estimated units that we believe we're going to be able to take out of there. So if it is in, say, here they're doing ounces of silver, then we're going to divide that total, essentially, depletable base, I guess we could call it, very similar to our depreciable base. We can take that depletable base and divide it by the estimated ounces of silver that we think will be in that mineral deposit, right? So we have all of these different items that could essentially tell us what the depletion per ounce would be for this specific example. And once we decide that we are actually going to be taking units out, and we do successfully extract those units from our, or in this case, ounces, from our natural resource, then we can do our depletion entry. It's a little bit different from the depreciation expense and accumulated depreciation that you learned before. Here, since we're planning on selling it, we simply go ahead and put that into our inventory, and then we decrease our natural resource by the amount that was extracted. There's an alternative method that could be used. We could, instead of decreasing the silver mine, we can use an accumulated depletion. But really, either method is overall acceptable. If you're a company, you want to be providing as much information to the user as possible, you would probably use the accumulated depletion. That way, you're just kind of breaking out those different pieces of the calculation as much as possible. A few other things that we should be taking a look at. You can read about this. So I really think that this is a good thing for you to read just for your personal accountant development. So here they're talking about all of the changes that happened as they went through how they should be accounting for all of these types of very unknown ventures, right? So when we're trying to drill for gas, or when we're trying to pull or extract all of these minerals out of the ground, it is quite uncertain. We do have technology to help us have a good idea about what we're going to get, but it's really something that kind of it's up in the air. I don't have a better word for it at this time. It is 5 o'clock in the morning, so doing my best. So here, when we're taking a look at all of these different methods, notice here, so we're talking about the full cost concept and the successful efforts concept, and they're showing you this timeline about all of the different attempts that they made over time to try to find out the best way to account for all of these different efforts. And you'll notice, so FASME required oil and gas companies to follow success for efforts. There was criticisms to that, so they decided to change it. There was another change a couple years later in regards to suspending a requirement, and then they abandoned everything, and currently they use either the full cost approach and successful efforts approach. So it's kind of like it just goes full circle. You're never going to make everyone happy when it comes to accounting, and there's always going to be some type of gray area. So keep in mind, this is why we always say when you're in these classes, especially at the upper level, if you're going to be an accountant, things are going to change all the time. For example, leases have been the big one probably for the last decade. The lease accounting rules have changed constantly. So I just think personally this would be a really cool area for you to spend some time on. Maybe go ahead and do some additional Google research just to kind of see if you can find additional information on the back and forth that happened here. But just something to, I don't know. Sorry, I should go back on topic, but this is a very fun section of the chapter. I'm sorry, nerding out just a little bit. Presentation and analysis, they're talking about the different ways that you can be showing this on your balance sheet. And then here we have some formulas: asset turnover, profit margin on sales, return on assets. I'm not too worried about these sections, by the way. If you want to know these formulas, that's great. I'll give you a little treat right now and tell you I'm not testing on them in this course. We'll save that for accounting for decision makers. Okay. So the last area that I kind of want to discuss is actually just a little bit of insight to intangible assets. Keep in mind, for PPE, we depreciate. When it comes to natural resources, we deplete. And in chapter 12, which we will go over once we get to meet next week, we will be learning about intangible assets. That'll be our last chapter. And a part of intangible assets, keep in mind, what is an intangible asset? You're talking about patents, trademarks, so on and so forth. Those items we amortize. So it's kind of like a nice continuation into that part of our balance sheet as we finish up our assets section. So we will discuss a little bit more about those intangible assets next week, but it's something that I think you should be reading in advance. Okay. All right, so at this time, I'm going to start compiling a few different videos. I'm going to bring in some old videos for your depreciation, and then I'm going to pull out a few videos for homework questions. As you look at the homework question videos, please, 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 just like we would in class, attempt the problem first. If you don't know how to start, use your textbook. Remember, part of learning is the struggle of looking up this stuff. If I just show you how to do it, it's very unlikely that you will retain it. Very few people have that ability, okay? So, all right, I'll go ahead and end this one, and I'll see you in the next video.